Pete, thank you for jumping on in front of a camera. We were very excited about talking about this topic with you. Can we talk about just how exceptional things truly are and whether you see this narrative gapping from being too hot to being too cold and happening very quickly?
You know, I've generally been bearish on the U.S. stock market, NASDAQ in particular, for a little while, and people look at you with this level of sympathy. And if you look at it since mid-January, it's heavily underperformed Europe. It's underperformed China massively, right? China's up 25, 30% since its January lows. So this whole perception that there's this exceptionalism and it's showing through the markets, I think, is an old story that we're clinging on to. And then you start looking at the data, right? Chicago PMI, and I understand Chicago's not what it once was in terms of the center of economic hub, but we are at a level that has previously only been associated with being in a crisis. So I think the data's there. Your previous guest, Veronica, I like the City Economic Surprise Index. That's turned negative again, right? So I think there's all these things that are going on behind the scenes. And maybe we've just been so fixated on inflation and the Fed that we're missing this real turn. And I think that's why we could see this gap back to hard landing talk.
Pete nailed it. We've been very focused on the central bank divergence, the prospect of the ECB cutting interest rates in June, and the Federal Reserve maybe not doing the same thing until much later this year. And to your point, we've missed the fact that the economic data has turned, that surprise index is now negative, that the price action, the performance has been elsewhere. So, Pete, the question to you is, does it continue? Do you see more people getting on board? And how would you play this theme now? Would it be through equities, through foreign exchange? What would you do?
You know, for me, I like rates right now. I started liking yields once they got above 460. I thought we'd be in a 10-year range, 440, 460. I think we might pull back to 430, 425 if the economic data continues weak. And to be honest, I think there's already been enough weak economic data that we've ignored. So I think we can see yields do better. So I think that's going to be the first way to play it. Then the question is, how do equities respond, right? Friday, we clearly had a Goldilocks type situation where bonds do well and stocks do well. I think that could fade, and I think that could fade rather quickly as people start saying, hey, this has only been a subset of the economy that's been exceptional. And there has been a subset that's been exceptional. If the rest of the economy starts fading, these cannot do that well. So I think you get a bit of a retrenchment. I think in the near term, I kind of like banks. I like some of those other sectors maybe to benefit from this Goldilocks type thing. But I'm now very worried that we're not going to see a smooth transition from no landing to maybe softish landing to hard landing. I think we might gap because the data already supports some of that fear.
There's a question about time horizon here and whether this is a tactical trade or a tactical view, or whether it's something that's strategic over the long term, where you start to see a greater chance of some sort of downturn that could more fundamentally challenge certain equity valuations. Which is it? Is it just tactical, or is it something that has longer legs?
For me, I think this is more fundamental. Again, we've been talking off and on for the past 6 months to a year that I view China resurgence as China trying to sell their own brands and compete more directly with us, which I think is going to put margin pressure on U.S. companies. And what I don't like, and my theory has always been, China will work domestically first, then sell into emerging markets, which they're doing. But I've always viewed kind of Europe as a potential weak link, right? We have the ability to confront China, to draw lines in the sand and fight with China, and our brands are super successful. Europe, to me, always strikes me as they're a little bit more dependent on China than we are. Xi's over there meeting with the French leader. I think you could see more go to that. And unlike in the past 20 years, where when China does well, we get a big slice of that here, I think we are going to get less and less of a slice of that and more competition. And so I think this is strategic about valuations, not just a technical or tactical trade.